So, I think you and I had spoken, others have said this is undoing 20 years of strategy.
Yeah.
Why is that a good thing?
So what's different this time, and quite frankly, it's going to take a while for the market to appreciate it, is what Christian Sieving and the management team has done is actually refocus the strategic direction of this company to really participate in businesses where they have sustainable competitive advantage. And going back to basics for this 150-year-old company is ultimately going to be a very successful strategic decision for the company, its employees, and its shareholders.
Those shareholders, at least this morning after the conference call, seem to differ, at least in that view.
Yeah.
What is it that you feel you understand that perhaps they don't appreciate?
Well, so, I don't worry about the day-to-day trading, and I focus a little bit more on long-term value, and my capital is long-term. And so what the shareholders are scarred by that 20 years of moving in the wrong direction. And, many of those shareholders were literally left for dead by the side of the road. What's different this time is these four really important factors. One is this change is a change in strategy. It's not trimming, it's not restructuring. This is a strategic move for the company. The second thing that's different is they are changing the scope and the parameters of their investment bank. They're really going to focus in on those businesses that facilitate their corporate bank. So they're going to take 2/3 of the capital that was allocated to the investment bank today and turn that into 1/3 of the capital going forward. The third thing that's different is they are really getting at the heart of driving efficiency by exiting businesses and integrating their merger with Postbank. So of the 6 billion euros in expense saves, 5 billion of those are coming from merger integration and business exits. And then the last thing, which is really important, is they're liberating capital to pay for this themselves. They've created this capital release unit. The company will reduce its leverage by 20%. They'll increase their liquidity by 20%. And they will ultimately be in a position where they can return capital to their shareholders.
So they don't need to raise any new capital, in your opinion? I mean, there are some this morning who said, well, they should have done even more. And they should have actually accompanied all this with a big raise of equity as well to sort of put to bed any concerns.
So to be fair, those same people today were saying yesterday, oh my goodness, they're going to have to raise capital, how terrible that will be. So again, when you think about this business on the numbers and in the long term, what Christian and this management team are doing is focusing on traditional consumer businesses, commercial banking businesses. They're stable. They're not terribly sexy, but they are long-term profitable. And the capital that they're liberating from reducing their balance sheet will pay for those restructuring charges. So this becomes
a large commercial European bank.
Yeah, so what's really hard for the research analyst community to understand is for the last 20 years, managers have been telling people, compare me to JP Morgan, compare me to Goldman Sachs.
Well, investment banking, as you all know, has pretty high margins when it's working well.
Well, it does if you're a leader in those businesses. So where Christian is taking his investment banking business is to only focus on those businesses where he has a leadership position. So 75% of the revenue going forward will be in businesses where they are 1, 2, 3, 4, or 5, a top player
of what's left of the
investment bank.
But to those, Doug, who say either you're in or you're out, I mean, you can't. Are you kidding? You be an investment bank without a global equities business? When you walk in, and again, you know this very well, to a CFO, don't you need corporate solutions that sort of span the capital markets?
So I actually hail from a company in JP Morgan Chase. Chase, the original business, was a commercial bank that built an investment bank around its strength: fixed income, structured finance, FX trading, to go with their corporate clients globally. That's the business that Deutsche Bank will do going forward. It is very, very attractive. It is profitable, and it fits with those million clients that Christian talked about this morning in their corporate bank. It sells a product to a treasurer, not necessarily a CEO, And that product is a very stable, low capital, high return business. And I would add, the remaining businesses that Deutsche Bank have leadership positions, whether it's in the private bank or in asset and wealth management. Those businesses are very attractive, very high ROE businesses over time.
But they get rid of essentially a lot of high-priced talent as well. Even in the investment bank you're describing, the people who sell these services, I would think, are not earning nearly what your typical investment banker, M&A advisor, or equity focused investment banker is making.
Yeah, I mean, the core of that revenue is going to be associated with businesses that are technology driven, that are driven by pure execution and low cost funding. And, I would add, by the way, this new Deutsche Bank, 85% of its funding is going to come from deposits, the lowest cost of funding, and from equity and ultimately long-term debt. So they're shrinking their need for capital and liquidity, and that's going to make them more profitable as well.